Welcome, everybody. Just give people a chance to log in. It's just gone 5 o'clock. And there are, I think I can see 20 people already, which is great, but we'll just give people a couple more minutes before we start. I'm actually rather chuffed to say that we've got people from 16 countries, as far as I can tell. So in addition to people from across Australia, we've got people from, looking at my list here, Switzerland, Kenya, Malta, Austria, Slovenia, Namibia, Hong Kong, Japan, Germany, France, Britain, the UAE, Dubai to be specific, Georgia, Indonesia, Malaysia, and I think that's it. So that's fabulous to have people from that so much of a span around the world. At this time of day, it's a bit much to expect people from either North America or South America to be getting out of bed in the middle of the night, but good afternoon or good morning to you wherever you happen to be. And so, having said that, let's get this show on the road. I'm going to share my screen, which I hope I'm doing now. Yes, there we go. So again, welcome. I'm going to talk about the economic outlook for 2021. And in particular, I'm going to be talking about the world economy, not looking at too many countries individually, although if there are ones in which any of you have a particular interest, feel free to mention that during question time. And then looking in more detail at the Australian economy, how it's been tracking and how it's likely to fare in 2021. And it's certainly my intention to allow time for questions, which the best way of putting is probably through the chat function, although if things work as we've planned, then there might be the opportunity to ask them directly if you'd prefer to do it that way. And I'm also going to ask my business partner, Rati Lahur, to say a few words at the end about what's next for this website through 2021. I should emphasize before I get underway that nothing that you're about to hear constitutes investment advice, and it shouldn't be construed as such. To paraphrase something Alan Greenspan famously said, if you think anything I've said is investment advice, then you almost certainly haven't understood it. And to remind, I don't work for a big Australian or global investment bank anymore. So if you do think that I've given you investment advice and end up losing money, there's not much point in suing me either, because you won't probably get enough even to cover your legal fees. So let's turn to look at the world economy, and you really can't do that without considering what's happening with the virus. I think the experience that the world as a whole and individual countries have had tells us fairly clearly that unless you get on top of the virus and keep it at bay, you can't have a sustainable economic recovery. There will always be some risk that either the government needs to lock down again, as we're seeing happening across Europe and in parts of the United States, and also more recently in North Asia as well. Korea is doing that. Or if governments aren't willing to lock down, then people will voluntarily observe restrictions on what they do. Either way, it will have an adverse impact on economic activity. Of course, the good news has been that we're much closer to having a vaccine, I should say, become more widely available. And already in both the United States and the United Kingdom, that has started to be rolled out, although it'll be some time before it reaches all countries and before a significant proportion of people in each of the countries where it's available have been effectively vaccinated. But until that time, until and unless the virus is kept at bay, then you can't really talk about a sustainable economic recovery. And for the world as a whole, the reality is that the virus is still out of control. The number of new cases is continuing to rise, in some countries at record rates. And the number of deaths has been rising since the middle of October as well. And although the proportion of people who catch the disease who end up dying of it is significantly less now, than it was during the first wave of infections in March and April, partly because more younger people are catching it, and it's less fatal for them typically than it is for people in older age groups, and because health professionals have learnt more about the virus as time has gone by and have been able to give more effective life-saving treatment to people who would otherwise be at risk of dying from the virus. But still, all of those trends look bad, and in reality, on the ground, in a number of countries around the world, the trends are undoubtedly bad. If we look at a bit more detail, you can see that in the United States in particular, the trend of new cases is still rising. It's been rising for longer in Europe, although there are signs that in Europe as a whole, if not for every individual European country, the number of new cases has reached a peak. Cases are rising in other parts of the world as well, in particular in the Middle East, in South Africa. In Turkey, there's been a striking acceleration in the number of new cases over the last 2 weeks, and in Russia as well, the number of cases has begun to rise again. The number of cases has leveled out at quite a high level in some Latin American countries like Colombia, Mexico, and Chile. And it's continuing to rise in Indonesia. Almost certainly, the number of cases there is higher than's been reported because the testing regime is so low. But in particular, you can see that if you put together Europe, Canada, Russia, Turkey, Iran, Pakistan, and Kazakhstan, another country in Central Asia where there's been a significant increase in cases, then those groups alone account for more cases than the rest of the world put together. And in all of those countries where cases are either high or rising or both, the probability is that economic growth will be slower in the fourth quarter than it was in the third. And in some cases, economic growth could be negative again, either in the fourth quarter of this year or in the first quarter of 2021. There has, as I mentioned, been some good news regarding vaccines. There are 3 viable vaccines that are now on the market, as it were, and which are starting to be administered to people in the US and the UK. And most governments, at least in the rich world, have entered into contracts with one or more of those 3 providers to ensure that they'll be able to get enough to start inoculating people in the early part of 2021, if not before then. But a critical question for individual countries in the world as a whole is, will enough people be prepared to take them to achieve what epidemiologists call a sufficient level of herd immunity to reduce significantly the risks of transmission of the virus? And if we look at research that's been done either by opinion pollsters or epidemiological researchers, the picture varies across the world. For example, in China, Brazil, South Africa, Korea, and Mexico, as you can see here, close to 80% or more of people have indicated that they would be willing to take a COVID vaccine. But there are other countries, including Russia, Poland, and perhaps more surprisingly, countries like France and Nigeria, where the proportion of the population who say that they would be willing to take a vaccine is surprisingly low, 50 to 60%, which wouldn't be enough if that were borne out in real life to give an assurance that the vaccine, that the virus's circulation within the broader community won't be significantly restricted by a vaccine becoming available. Here in Australia, where I'm showing here some research done and published last month by health researchers at the Australian National University, the suggestion is that about 60% of our population definitely would take a vaccine and about 28% probably would, which is, I think, sufficient to be comfortable with the idea that we will be able to achieve an acceptable level of herd immunity through the administration of a vaccine. And almost certainly we'll be able to do that ahead of the schedule that Treasurer Frydenberg indicated in his budget that was brought down in October, where he assumed that a vaccine would become widely available towards the end of the second half of next year. We'll probably be able to do better than that here in Australia. But turning to how the economy is travelling, 91 countries reported economic growth figures for the second quarter, And of those, only 2 reported positive growth. On the other hand, 9 reported contractions of more than 20% compared with the second quarter of 2019, and 39 reported contractions of between 10 and 20% between over the year to the second quarter of 2019. You can see in this chart, the countries represented in this webinar are shown in pink. So, for example, among those, the United Kingdom saw economic growth contract by more than 20% over the year to the second quarter, which is an extraordinary decline. As a crude generalization, the countries which experienced the sharpest contractions over the year to the second quarter of this year were either those who were incompetent in their management of the virus, which would be true of the United Kingdom, for example, or which are significantly exposed to tourism, which would apply to countries like Macau, Mauritius, Peru, Botswana, Spain, Tunisia, Malta, among others that are shown in this chart here. We've now had more than 60 countries reporting their third quarter GDP. And again, those that are represented here this afternoon or this morning are shown in pink, along with Australia in yellow. There are now 5 countries who have reported positive growth in the third quarter compared with the third quarter of 2019. And there are only 5 who are still more than 10% lower than they were in terms of the third quarter 2019. Some countries have seen quite significant rebounds, but others, including the UK, for example, and the Philippines, are still very weak by comparison with where they were when the pandemic began in the first quarter of this year. With 61 out of the 90 countries that do report quarterly economic growth having provided our numbers, you can put an estimate of overall world economic growth, and that suggests that by comparison with the third quarter of last year, global economic activity was down by about 2.25%. That's a significant improvement over the 8.5% decline in world GDP over the year to Q2 to the June quarter, although it will still be well into 2022 if all goes well, before the level of global economic activity has returned to where it was in the fourth quarter of last year, before the pandemic hit. And it will be longer again, a matter of years, before the level of economic activity is back to where it might have been over the longer term if the pandemic had never occurred. That's probably a better measure of the economic opportunities that have been foregone as a result of the spread of this virus. Just delving that into a bit more detail, if you look closely at the previous chart, you might have seen that the country with the fastest growth in the world over the year to Q3 was not China, as you might have expected, but rather Ireland, which reported growth in real GDP of 8% over the year to the third quarter. But that's a deceptive figure. Irish figures are highly volatile and often a misleading indicator of underlying economic growth because they're frequently distorted by large gross flows associated with the activities of multinational enterprises that are attracted to Ireland because of its very low company tax rate, and in particular by the activities of aircraft leasing companies that are often located in Ireland. And their transactions get into the balance of payments, exports and imports, and into payments of factor income, that is the repatriation of profits and dividends by companies that have their tax domicile headquartered in Dublin or some other part of the Republic of Ireland. One way of looking through that is to focus on real gross national product rather than gross domestic product, which abstracts from payments of net factor income. And you can see there that real GNP tells a very different story from real GDP. That measure contracted by 9.3% over the year to the third quarter. The Irish Statistical Office, the CSO, publishes another measure which they call modified domestic demand that abstracts from all of these transactions more comprehensively than real GNP does. And that did show a big swing, as most other countries experienced between Q2 and Q3, but that measure is in Q3 4.1% lower than it was in the third quarter of 2019. And perhaps a better handle on what's happening in Ireland can be seen by the fact that the unemployment rate rose significantly between April and November, the latest available data, by almost 3 percentage points. As in most other Western countries, the rise in unemployment would have been much greater if it wasn't for the wage subsidies and furlough schemes that governments across Europe and here in Australia have put in place to stem the rise in unemployment. But the fact that unemployment hasn't begun to come down tells you that Ireland is still in recession, notwithstanding the attention-grabbing figure for real GDP growth that it recorded in the third quarter. The second country on the list was also not China, but one you wouldn't have expected to have been doing as well as it did, and that's Turkey. The rebound in the Turkish economy in the third quarter was the result of a credit boom engineered by the Turkish Central Bank acting under directives from the government. The Turkish Central Bank dropped interest rates by 16 percentage points almost over the year to June 2020, and the central bank made open-ended liquidity commitments to the commercial banks, which saw them boosting their lending by more than 40% over the year to the June quarter, or 30% in real terms. Growth in mortgage lending was over 100%. That is, the stock of mortgages doubled in the course of a year in Turkey. And you can see what that looks like on that chart of bank lending. As a result of this blowout in domestic demand, Turkey's current account widened to over 7.5% in GDP, turning around from a surplus the year before, which put renewed downward pressure on the Turkish lira, that's fallen by more than 30% against the US dollar this year, which in turn has put upward pressure on inflation again after it had been brought under control at significant economic cost in 2018-19, which has in turn in recent weeks forced the central bank in Turkey to raise interest rates very sharply, contrary to the expressed strong preferences of President Erdogan. And those higher interest rates, combined with the spike in COVID-19 cases that's been very large in Turkey, will almost certainly see Turkey go into negative growth in Q4. So in reality, the strongest sustainable economic recovery so far is happening in China, and that matters for the rest of the world because it's the world's largest economy by some measures and the second largest by others. Just looking briefly at the other end of the scale, the world's worst recession has been in tiny Macau, which, as you will know, is a special administrative region of China similar to Hong Kong, has a tiny population of just under 700,000 and a very small economy of 54 billion. But it is, or at least it was, the richest economy in the world measured by per capita GDP, the per capita GDP of over almost 122,000 US dollars in 2019, compared with the US itself, which had a per capita GDP on that basis of just over 65,000 US dollars. If any of you have been to Macau, which I haven't, you'll know that it really is based on one industry. More than half its GDP is attributable to what even the statistics office calls gaming and junket activities. And if you combine that with real estate, banking, retailing, hotels and restaurants, you've got another quarter of the economy there. And of course, these were things that were dramatically affected by restrictions on travel and non-essential activities as the pandemic broke, particularly, of course, in China, which has sovereignty over Macau. Those activities effectively dropped to zero in the second quarter from the time when restrictions were first imposed in February, and you can see that in these charts. And because they are such a big part of GDP, the end result was that GDP dropped by almost 70% between the December quarter of 2019 and the June quarter of 2020. And even with an 11% rebound in Q3, the level of economic activity in Q3 in Macau was still 66% below the fourth quarter of last year. And you can see what that's done to unemployment and in particular underemployment, that is people who still have a job, but working far fewer hours than they are willing and able to do. And with the best will in the world, Macau isn't going to return to pre-pandemic levels of economic activity until 2024 at the earliest. I just thought I'd mention those three because they were a bit eyebrow raising at either end of the spectrum of countries' outcomes. I'm not given the time available, going to go into any more detail about other countries like China, the United States, Europe, etc. Although if there's some interest in those, please feel free to put some questions when we get to question time. The other 2 points I did want to note are just to emphasise that around the world, not just in Australia or New Zealand, governments are doing an extraordinary amount of fiscal stimulus, much more than they did during the global financial crisis, as these charts bear out. Most of what they're doing is on the expenditure side, although some governments have either foregone taxes to which they'd otherwise be entitled or reduced tax rates a little bit, VAT rates, for example. But overwhelmingly, the fiscal measures are taking place on the spending side of budgets, and they're resulting in significant increases in the level of public debt. Central banks are also doing what they can. They've reduced interest rates to record lows, which in most countries didn't actually require them to do very much because they'd been at close to record lows ever since the financial crisis of 12 years ago. It was really only in North America, in the United States and Canada, where central banks had been raising interest rates towards the end of the past decade and then cut them very swiftly down to close to zero as the pandemic hit. I also think it's worth noting that those central banks which had negative interest rates going into the pandemic, that is specifically, as I've shown here, the Bank of Japan and the European Central Bank, but also the Swiss National Bank, haven't seen fit to make them any more negative, despite the onset of what has been for each of those countries the most severe recession since the Great Depression. And I think that's telling, that you'd think if negative interest rates actually did any good, then in the face of such a severe downturn, they would have taken them further into negative territory. But I think what that tells you is that, in fact, negative interest rates don't really do much good, especially in circumstances where banks can't pass them on to their customers, in effect pay them for taking out loans. So what negative interest rates do actually do is, in effect, impose a tax on banks. And in circumstances where banks are not very profitable, not Australia, of course, but in Europe, that's certainly been the case, then that's not necessarily what you want to do at a time when you want the banks to be keeping the supply of credit up to businesses in particular that are otherwise struggling to meet their essential outgoings. But although central banks haven't been able to do much with regard to interest rates, they've been doing a lot of quantitative easing, or QE, as it's become known. All the banks that did quantitative easing during the financial crisis of 12 years ago are doing an awful lot more of it as a proportion of GDP. And some central banks which didn't do quantitative easing 12 years ago are doing it now. That includes the Bank of Canada among the larger economies. It also now includes Australia and New Zealand, and it includes a number of central banks in emerging economies, including Korea, the Philippines and Indonesia in our part of the world, are all undertaking various forms of quantitative easing. You'll remember that during the financial crisis, there were those who said that this was printing money in the same way that most famously Weimar Germany did in the early 1920s, and more recently Zimbabwe and Venezuela have done. The reality is that that's not what these central banks are doing. They're not literally printing banknotes in order to pay public servant salaries, for example. Rather, they're purchasing financial assets, and the money that they create in order to purchase those financial assets ends up being deposited by commercial banks on the other side of central banks' balance sheets. So although quantitative easing has prompted a faster acceleration in money supply growth than it did during the global financial crisis, it hasn't resulted in a noticeable acceleration in inflation in any of the major economies in particular. And I don't think it will, unless major economies go down a protectionist path, seeking in the name of ensuring the supply lines of so-called strategic products that they retreat into pre-1990s protectionism. Fortunately, there doesn't seem to be any significant sign that that's happening either. So I think some of the concerns that quantitative easing, as it's being practiced by central banks around the world today, is going to lead at some point to a spurt in inflation is, I think, a misplaced fear. On the contrary, most central banks are confronted with inflation that is well below the targets that they have. And of course, that applies to Australia and New Zealand as much as it does to the major economies that I've shown here.